You've heard every single word in this video. You've nodded along to every single one of them in a conversation. You understood none of them, and the person using them knew that. They were counting on it. Finance jargon exists for two reasons. One, to describe something specific. Two, to make sure you stay confused enough to keep nodding. This video handles reason 1, 10 words. What they actually mean. No jargon used to explain the jargon. And there is one word on this list that brought down Lehman Brothers, a 158-year-old bank, in a single year. Wiped out millions of investors, still used casually in every trading app you've ever opened. We'll get to that one. But first, 9 other words finance bros use to sound smarter than you. Let's get right into it. Number 10, correction. Every time the stock market falls, every news anchor says the same thing. Markets are undergoing a correction. Not a crash, not a fall, a correction. As if the market was misbehaving and needed to be disciplined. Here is what it actually means. Prices fell 10% or more from their recent high. That is the entire definition. Finance named it a correction because it implies the previous price was wrong and the market is now fixing itself. Nobody actually knows if it is fixing itself or falling further. Your portfolio is down. The anchor sounds calm. The word is doing a lot of emotional management for not containing very much information. A crash by any other name still hurts the same. Number 9, volatility. You've seen this word in every market update you've ever half read. Markets are experiencing high volatility. Volatility is elevated. Volatility concerns investors. It sounds like a medical diagnosis. It isn't. Volatility simply means prices are moving a lot, up and down, in a short period of time. That is the whole definition. Nothing more. When markets are calm, volatility is low. When everyone is panicking or celebrating, volatility is high. Finance even built an entire index to measure it, the VIX, which Wall Street calls the fear index. High VIX means everyone is scared. Low VIX means everyone is comfortable. So, when a finance bro says markets are volatile, translation, things are moving fast, and nobody knows where they land. Number 8, derivatives. Every RBI warning contains this word. Every budget discussion has a minister looking gravely concerned about it. Derivatives sound like something from a chemistry lab. They are not. A derivative is a financial product whose value depends on something else entirely. That is the whole idea. If you place a bet that Infosys shares will be above 1,500 rupees next month, that bet is a derivative. Its value is derived from Infosys's actual price. Options and futures are the most common derivatives in India. Used correctly, they manage risk. Used incorrectly, they multiply losses at terrifying speed. Warren Buffett once called them financial weapons of mass destruction. Most retail investors treat them like a shortcut to wealth. Most retail investors lose money on them. Number 7, circuit breaker. Imagine the stock market falling so fast that someone physically has to stop it. That is a circuit breaker. When Indian markets fall 10% in a single day, trading halts for 45 minutes, fall 15%. Trading stops for nearly 2 hours, fall 20%. The entire market closes for the rest of the day. The idea came from the 1987 US market crash, when prices fell so hard and so fast, the system couldn't cope. A circuit breaker is essentially a panic button built into the market itself. It gives everyone time to breathe, get information, and stop making decisions purely out of fear. It sounds dramatic because every situation that triggers one actually is. Number 6, arbitrage. Finance bros love dropping this one casually. Oh, I just did a quick arbitrage play. Sounds sophisticated. The concept is embarrassingly simple. Arbitrage means buying something cheap in one place and immediately selling it at a higher price somewhere else, profiting from the difference. That is it. If onions are 20 rupees per kilogram in Nashik and 35 rupees in Mumbai, buying in Nashik and selling in Mumbai is arbitrage. In stock markets, it works the same way across different exchanges or financial products. The reason it sounds complicated is that finding these price gaps in modern markets requires sophisticated algorithms. The concept itself requires approximately zero sophistication. Finance bro says arbitrage. Translation: I bought cheap and sold expensive at the same time. Number 5. Short selling. You've heard this one since the Adani Hindenburg controversy. Hindenburg was short selling Adani. Half of India thought this was illegal. It isn't. Short selling means borrowing shares you don't own, selling them immediately, waiting for the price to fall, buying them back cheaper, and returning the borrowed shares, pocketing the difference. You are essentially betting that a company's price will fall. If you are right, you profit. If the price goes up instead, your losses are theoretically unlimited. That last part is why it sounds terrifying. That last part is also why most retail investors should never do it. Hindenburg Research does this professionally. They are also very good at finding genuinely problematic companies. Number 4. Hedge Fund. Every finance movie has one. Every Adani article mentioned one. Hedge fund managers appear on CNBC looking important. Here is the unsexy reality. A hedge fund is just a private investment pool for wealthy investors that is allowed to use more aggressive strategies than a regular mutual fund. The word hedge originally meant reducing risk, betting on multiple outcomes so you can't lose everything. Most hedge funds today barely hedge anything. They use leverage, they short sell, they trade derivatives, whatever generates returns. Here is the part nobody tells you. Study after study shows most hedge funds underperform a simple, boring index fund over a 10-year period. The strategies are complicated, the fees are high, the results are frequently ordinary, exclusive by design, complicated by reputation, ordinary by outcome. Number 3. EBITDA. This one lives on every LinkedIn post about startup funding. Company clocked 500 crore rupees EBITDA. Finance bro drops it, moves on. Nobody asks. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, which in plain language means profit, before we subtract all the inconvenient expenses. A company reports EBITDA when its actual profit after all costs looks less impressive. It is not a fake number. It does tell you something about operational performance. But using it instead of actual profit is like reporting your salary before rent, EMI, groceries, and every other bill you actually pay. Finance bro says strong EBITDA. Translation: we make money before we count what we spend. Number 2. Quantitative easing. This one appeared in every COVID news cycle. Central banks announced quantitative easing. Sounds highly technical. The concept is almost embarrassingly straightforward. Quantitative easing means a central bank creates new money and uses it to buy government bonds and financial assets. The goal is to push more money into the economy and keep borrowing costs low during a crisis. India's own RBI did something similar during COVID, pumping over 8 lakh crore rupees in liquidity into the system to keep banks lending and businesses breathing. The side effect everywhere was the same. All that new money made existing money worth slightly less, which is one of the reasons inflation spiked after COVID, globally and in India. Finance bro says quantitative easing. Translation: the government printed money, pushed it into the system, and hoped the economy would start moving again. Number 1. Leverage. Every trading app offers it. Trade with 5 times leverage. 10 times leverage available. It sounds like a superpower. It functions like one, in both directions. Leverage means using borrowed money to invest more than you actually have. If you have 1 lakh rupees and use 5 times leverage, you are controlling 5 lakh rupees worth of positions. If the trade goes up 10%, you make 50,000 rupees on a 1 lakh rupees investment. If it goes down 10%, you lose 50,000 rupees, half your actual money. The downside is not symmetrical. This is why leverage is the most dangerous word in finance. It is also how Lehman Brothers, like 158 years old, one of Wall Street's biggest banks, collapsed in 2008. They were leveraged 30-1. When their investments fell by just 3%, the entire firm was wiped out in weeks. Your trading app does not tell you that part when it offers you 10 times. It just calls it a feature. That's all for today. I'll be making similar videos in the future. Subscribe to see them.